Real estate expert and wealth development coach Zaki Ameer says the majority of property investors are ruining their overall earning potential and opportunity for financial independence by investing in negatively geared property. He joins us. Zaki, why don't you like negatively geared property?
Well, negative gearing basically means that the expenses that you have relating to the property in terms of, say, loan repayment, council rates, strata fees, is in excess of the rental income you receive. And so majority of, investors focus on negative gearing in terms of tax benefit, where because you're making a loss or an expense, or you could claim higher deductions. But what they don't consider is that if the properties are negatively geared, that means the properties are costing you money, which means your taxable income, which is either through your primary job or primary business, is servicing or looking after these shortfalls. So it's good if things are good, but what they don't consider is, for example, if the investor loses their job or there's a change in circumstances, say, mom gets pregnant or they, lose the job or they are redundant or there's a change in the economy where there is significant job losses, they need to come up with this shortfall because the properties are negatively geared.
Yeah.
And this is where investors run into trouble when the economy changes and then you see mass selling happening, is because they can't sustain the investment anymore.
Negative gearing, though, is not really a strategy, is it? It's just a demonstration that the investor has limited funds to invest at the outset?
That is correct. It's not a strategy, but there are a lot of people out there, I guess, why they're accountants and all of that, and seminars where they promote negative gearing as a strategy. For example, they promote off the plan or brand new property, saying, it's a brand new property so you can claim more and all of that. But it's not really a strategy. It's just a benefit. And people should not look at it as a strategy where they're just making use of the benefit that's available in Australia at the moment.
Yeah, Zaki, I read somewhere that you said negatively geared property assumes high capital growth and positively geared property generates low capital growth.
Mm-hmm.
Isn't that a good reason to accumulate negative geared property, though, if you're chasing growth?
Most definitely, but what we have to look at is if you're doing it to build a portfolio, and most people buy properties, to create wealth, not because they're just bored. When you're building a portfolio of investments, you want to have a balanced portfolio. What that means is your overall portfolio, just like running a business, between the negatively geared properties and the properties that are putting money in your pocket after rent, are well balanced. So it's okay to have negatively geared properties as long as they're well balanced with positive cash flow properties. And the same rule applies that you don't want to focus too much on positive cash flow properties, say in regional areas of Australia, chasing rental yields, because then you're going to be hit with the other issue of income but no growth.
Isn't smart investing, though, about finding the right property at the right price in areas with strong drivers for capital growth and having the property pay for itself, not just through the income but also through the tax man? Not
really, because then we're holding the assumption that you're only investing because you're going to be working. So it's good to be, having the taxman in your benefit. But if you're building a portfolio of investment properties to retire or retire early, then the assumption is you're going to be working, and that's why you're going to be claiming this back. So in my view, and then you're not considering, like I mentioned in the beginning, the change of circumstances, because you're making the assumption that you're always going to be working. So it needs to be looked at more broad, and I'm not saying it's bad, it just needs to be considered that, that could be a change in circumstances that you need to account for.
Kerry Packer famously said anybody in this country who doesn't minimise their tax wants their head read. Isn't tax minimisation at its smartest, though?
Tax minimisation is smart. I mean, for sure. I mean, we all pay tax and we want to, reduce the tax, but at the same time, you don't want to just rely only on a strategy. Like I'm saying, if you're focusing just on negatively gearing and chasing that and not considering other changes in circumstances, then you're probably cutting yourself short. And this is what happens post-GFC or every time there's economic downturn, where selling off happens because people can't sustain investments anymore because they've had a change in circumstances.
Yeah, we've seen recently people chasing positively geared property. It means that they have to go to some markets. They're not really easy to find, so they go to some of the more high-risk markets like the mining towns, and we all know what happened there. Surely that is too risky, though, to be chasing that type of investment.
Most definitely. Once again, if you chase only that without considering anything else, but the thing is with mining towns, what they're talking about higher rental yields, which is positive cash flow, but then they're also saying high capital growth or increasing value significantly because that area hasn't been, exploited before. But then that capital growth can only be short-term, which means you need to know when to get in and you need to be able to know exactly when to get out before there's an industry change that can happen anywhere globally.
Zaki, thank you very much for your time.
Thank you very much.